Good evening, everyone. Today's live session is on role of asset allocation. Myself, Indranil. Asset allocation is a fundamental concept in the field of investment management. It involves the process of dividing an investment portfolio among different asset categories, such as stock, bond, real estate, and cash, to achieve a balance between risk and return that aligns with an investor's financial goals, risk tolerance, and time horizon. The role of asset allocation in financial planning and wealth management is critical of several reasons, including risk diversification, achieving financial achievements, and optimizing portfolio performance. The article explores the importance and impact of asset allocation in detail. Number one, risk diversification. One of the primary roles of asset allocation is to reduce risk through diversification. Different asset classes respond differently to market conditions. For example, when the stock market is volatile, bonds might provide more stability, while real estate could act as a hedge against inflation. By spreading investment access across various asset classes, investors can mitigate the impact of poor performance in any one category. This approach ensures that the overall portfolio is less affected by market fluctuations, thereby reducing the likelihood of significant losses. Balancing risk and return. Every investor has a unique risk tolerance, which depends on factors such as age, financial goals, and income level, and investment experience. Asset allocation helps tailor an investment strategy that matches this risk tolerance. For instance, a young investor with a long time horizon and a high risk tolerance might allocate a larger portion of the portfolio to stocks, which have higher growth potential but also higher volatility. Conversely, a retiree with a low risk tolerance may prefer a portfolio dominated by bonds and fixed income securities to preserve capital and generate steady income. Achieving financial goals. Proper asset allocation plays a pivotal role in helping investors achieving their financial goals. These goals can range from saving for a child's education, purchasing a home, or building a retirement corpus. Each goal may have a different time horizon and risk tolerance, necessitating a specific asset allocation strategy. For example, short-term goals might require a more conservative allocation to ensure capital preservation, while long-term goals can accommodate a more aggressive approach to maximize growth. Managing market volatility. Financial market are inherently volatile, and asset prices can fluctuate due to various economic, political, and global factors. Asset allocation act as buffer against such volatility by maintaining a well diversified portfolio. Investors can smooth out the effects of market turbulence. For instance, when equities are underperforming, fixed income assets or commodities like gold can provide stability and reduce the overall portfolio sensitivity to market swings. Enhancing portfolio performance. Strategic asset allocation ensures that an investor's portfolio remains aligned with the financial goals and market conditions. By periodically reviewing and rebalancing the portfolio, investors can optimize returns while maintaining the desired risk level. These involve selling overperforming assets and buying underperforming ones to restore the original asset mix. Rebalancing prevents the portfolio from becoming overall skewed towards high risk assets and helps capture potential growth opportunities. Protection against inflation. Inflation erodes the purchasing power of money over time, making it crucial for investors to include assets that can provide inflation protection in their portfolio. Real estate, commodities, and inflation linked bonds are examples of asset classes that typically perform well during inflationary periods. A well thought out asset allocation strategy ensures that the portfolio includes a mix of assets capable of outpacing inflation and preserving the investor's wealth in real returns. Emotional discipline. Investing can be an emotional journey, especially during periods of market volatility. Fear and greed over often drive investors to make impulsive decisions, such as panic selling during market downturns or over investing in a booming market. Asset allocation instills a sense of discipline by providing a structured framework for investment decisions. It helps investors stay focused on their long term goals and prevents emotional reactions that could undermine portfolio performances. Adapting to life changes. An individual's financial situation, goals, and risk tolerance are likely to change over time due to factors such as marriage, the birth of a child, career advancement, or approaching retirement. Asset allocation allows for flexibility and adaptability to these changes. For example, as an investor nears retirement, that may shift from a growth oriented portfolio to that prioritize income the capital prevention. After all, the role of asset allocation in investment planning cannot be overstated. It provides systematic approach to managing risk, achieving financial goals and optimizing returns. By diversifying asset across classes and periodically rebalancing the portfolio, investors can navigate market uncertainties with confidence and discipline. Whether for a novice